So how vulnerable are stocks for more downside here? Tim, what do you say?
Well, what's interesting to me is we came in this morning and equity futures last night, I'm sure most people were glued to their screens after the weekend's events, and we were seeing a rally. And we were seeing a rally also with possibly a move higher in rates. And that was really how we started out this morning. And I recognize that markets price in a lot. We priced a lot in Friday afternoon going into this weekend on the expectation of, unfortunately, what happening. Having said that, it was a week where we sold off on the back of yields. I mean, it was a week where we sold off on the back of a handful of things. But when you started to see the day play through and there was no flight to quality in bonds, which should have meant Treasury should have been rallying. The dollar should have been rallying. The dollar actually at one point was actually off small. But the fact that some of the trades that I would have expected to have seen this morning hadn't taken place, I just found is weird, even though I know we were in a place where Friday afternoon risk was significantly high. Look, the VIX closed well through the levels on Friday. I think we are in a kind of a new range here. The S&P closed effectively on the lows after 120-point reversal intraday to close through the 50 to the downside, and it hasn't made a move to the downside through the 50 since September of 23. So I think we're in an environment where not only have we had a 4% move already in the S&P from peak to trough, but I think unfortunately we've crossed a Rubicon over the weekend. We haven't been here before with Iran, Israel. I think there are all kinds of implications, and I think some of them are even we're going to kind of contemplate that tonight.
Meaning Iran has never attacked Israel before, directly, as opposed to through surrogates, and that's the Rubicon that we have crossed over the weekend.
That's the Rubicon we've crossed, and I think there's left side tail risks galore.
Yeah, and I would just add to that, and I agree with you. I mean, we have geopolitical risks in multiple places around the world, and you would think that would lead to a flight to quality, which would pull yields lower. But we have other forces going on right now. The retail sales report, very, very strong, stronger growth, risks of higher oil prices from the Middle East, creating inflation expectation risks that could keep short-term rates higher for long. All of that's feeding into the long end of the curve. I think the big deal, though, today is the speed of the move. You know, if you have a very slow rise in yields and it's backed by stronger growth, you can see higher yields and higher stocks at the same time. When you have a fast rise in yields, it's unsettling. You have greater uncertainty, greater vol, and it's not necessarily coming just from better growth. I think that's when that tips the balance, the correlation the other way.
So all of that I totally agree with, but I also think this market was on such a tear that at some point you need an excuse to start selling things off. So we're just sort of at the beginning of earnings season. I think if things calm down, that's a giant if, and we get back to focusing on earnings, that could be good for the market. But it wouldn't surprise me to just continue to see down for a while. As you're this move in rates is really quite something. I don't know how much to attribute to the retail number, which was super strong. Also, the revisions to the prior months are huge.
They're seen as more important, too.
Yeah, and why are they so off? I don't quite get that. So that's kind of, as you were saying, you could have rising rates and the economy doing okay and the market sort of doing okay there. But this retail number seemed to actually be a negative, right? Just for what it did to rates.
It decelerated a lot. I mean, I'll just say this. You just said, Karen, you want to focus on earnings. And again, I go back to Friday and JP Morgan down 6.5%. I can't remember the last time I've seen that stock down more than 5% in a non-crisis sort of period. So what does that say? It's a very crowded trade. We've been talking about a lot of very crowded trades. They became very big market cap stocks. So this was a $500 billion market cap that was down 6% on a technical basis, broke trends. And let me tell you something. There's a lot of stocks, a lot of sectors, a lot of indices that are breaking these really very nice 45-degree uptrends that have been in place since October. So some of the technicals are starting to break down. And I just feel like once we get into earnings, I think expectations for so many stocks, we're only down 4% in the S&P from those all-time highs just made 2 weeks ago. I think expectations are high. What the geopolitics situation does to me, it muddies the outlook, right? And so if JP Morgan sold off because the CEO, the best CEO on the planet, right, was giving the sort of guidance that investors were not going to feel great about, and he was already telegraphing that earlier in the week with his investor letter, then I think there's more big downdraft for some single names that are very crowded to come. And again, they could have put up a really good Q1, but it really might be about just the lack of visibility they have in the future. And then if you just think about this, okay, we have high expectations for earnings growth for the S&P 500, 11, 12%. If you have the dollar where it is, you have rates where they are, you have commodities where they are, I mean, this is going to start start to put some pressure on margins, right? And that's going to put downward pressure on earnings. So I think we're going to have downward earning revisions, and that are going to come out of this. And so again, the S&P just seems a bit mispriced, in and around 5,100 or so. The last time we were 4.6 in the 10-year, the S&P was 4,600.